If you are close to retirement, you have probably heard the advice to hold off selling your investment property until after you finish working, so you pay less capital gains tax. It sounds sensible. But what if that wait ends up costing you an extra $50,000 not saving it? That is the trap I want to walk you through today. The 50% capital gains discount already cuts what you owe the Australian Taxation Office in half once you have held an asset for more than a year. That part works in your favour. The problem shows up when people try to be clever about the exact moment they sell, hoping for a better price or a lower tax bill. Property and a concentrated share parcel are not liquid. You cannot pick the day the market suits you. Waiting for the perfect window can mean selling into a falling market or triggering a bigger tax bill than if you had simply sold when you needed the money. By the end of this video, you will know 4 ways to sell an asset like this in retirement without gambling on timing, and how to tell whether waiting is actually costing you money. So let us start with the number most retirees never see coming: the real cost of waiting for the right moment. If you are an Aussie retiree sitting on a property or a share portfolio, wondering when to sell, hit subscribe now. I will show you exactly how the 4 strategies work. I have watched this happen to more than one retiree. They own an asset, they feel proud of it, and they treat the tax office like an opponent to outsmart by picking the perfect selling day. That instinct makes sense. It is also where the trap starts. Here is why the discount already does most of the work for you. Once you have held an asset, such as an investment property or a parcel of shares for more than 12 months, only half of the capital gain gets added to your taxable income. Take a gain of $200,000. Only $100,000 of that is actually taxed. For someone earning a solid income in early retirement, sitting in the 30% tax bracket, that works out to about $30,000 in tax. That is the system already helping you. The trap is believing you can also control when the sale happens. Property and a concentrated share parcel do not trade like a term deposit. You cannot log in and cash out at a price you choose. If you delay a property sale hoping the market improves, and instead it drops 10%, you have not saved anything. You have lost $20,000 in value, and you still owe tax on the gain you already had. That is $50,000 gone, tax and lost value combined, for the privilege of waiting. Meet Peter. He is 62. He owns a rental property worth $600,000 with a cost base of $300,000, and he holds another $200,000 in shares. Advisors have told him to wait until he turns 65 and stops working, on the theory that his income, and therefore his tax rate, will be lower by then. If you have been sitting on a property you bought 15 years ago, worried about the tax bill waiting for you the day you sell, you are not alone. That worry is normal. But the fear of tax is often smaller than the fear of losing the sale entirely. The trade-off nobody spells out is this. Every year Peter waits for the ideal moment. His choices actually narrow. His health, the property market, and interest rates are all moving whether he plans around them or not. The tax saving he is chasing is fixed and knowable. The cost of waiting is not. Peter is stuck in the classic trap, waiting for a moment he cannot actually control. The real problem is not the tax bill. It is the assumption that timing is his to manage. Next, I want to show you what happens when people try to time a sale like this, because the market has a long history of punishing exactly that instinct. This is not just Peter's story. It has played out at scale, and the numbers back it up. In February 2020, the ASX 200 sat near a record high. Within about a month, it had fallen by roughly a third, one of the fastest drops the local market has seen in decades. Anyone forced to sell an investment during those weeks locked in a real loss. The market did recover, but not on a schedule anyone could have picked in advance. It took close to a year to fully claw back to where it started. That gap between falling and recovering is the trade-off most retirees never price in. Research on share portfolios has shown that missing even a handful of the market's best trading days over a couple of decades can cut your final return dramatically. Here is the uncomfortable part. Many of those best days sit right next to the worst days. The rebound often happens while everyone is still too nervous to buy back in, or in this case, still waiting for the right moment to sell. That is the same trap Peter is in with his rental property. He assumes he can watch the market and pick his moment, but property is even less forgiving than shares. A share sale settles in days. A property sale can take months of listing, negotiating, and waiting on a buyer's finance to come through, and every one of those months is a month the market can move against you. You cannot sell half a house on a bad Tuesday and wait out the rest. Once you list it, you are exposed to whatever the market gives you that season. So what happens when you do not even get the luxury of waiting? When life sends you a bill you were not expecting? That is where the real stress test begins. 6 months into waiting for the right time, Peter gets a call. His wife needs a procedure that is only partly covered by their health insurance, and the gap payment comes to $50,000. That is not an unusual figure. Gap payments on major procedures regularly land between $20,000 and $50,000, even with private cover. Suddenly, Peter is not choosing when to sell. The bill is choosing for him. Here is the unprepared version. Peter lists the property in a quiet month because he has no choice, and it sells for $550,000 instead of the $600,000 it might have fetched with more time. His capital gain is $250,000. The discount brings his taxable gain to $125,000. And at his 30% rate, that works out to $37,500 in tax. After tax, he is left with $512,500, and the medical bill comes straight out of that. Now picture the version where Peter had already set up his exit years earlier. Instead of holding the whole property as one asset waiting for a single perfect sale, he had already arranged to sell a share of it, or had a plan to draw against it without a full sale. He is not scrambling to offload the entire property in a rushed, quiet season. He sells only the portion he needs, closer to a time of his own choosing, and keeps the rest working for him. Same property, same family, same bill. The difference is not luck. It is whether he built in a way to sell in pieces instead of betting everything on one perfectly timed transaction. So which version of Peter would you rather be, the one forced to sell everything at the worst possible moment, or the one with a plan already in place? In the next section, I want to give you the 4 actual strategies that make the second version possible. Now let us get into the 4 ways to sell an asset like this without gambling on timing. The first is a partial sale. Instead of treating the property or the share parcel as one all or nothing decision, you sell a portion of it. With a share portfolio, this is straightforward. You can sell parcels worth a few $1,000s at a time. With property, it usually means bringing in a co-owner, such as a family member buying in as a tenant in common, or selling a fraction of the holding, rather than the whole title. Either way, you are not forced to put the entire asset on the market on one day. The second is moving eligible shares into your superannuation fund instead of selling them on the open market first. This still counts as a disposal for tax purposes at the moment you transfer them, so you are not skipping the capital gains bill. You are choosing where the growth gets taxed from that point on. Inside a fund, a long-held gain is generally taxed at an effective 10%, well below what most people pay on income outside super. There is a limit on how much can sit in a tax-free pension account, the transfer balance cap, which sits at $2,100,000 from 2026. So this only suits people with room under that limit, and it is worth checking the exact figures with a licensed advisor before you act. This strategy applies to shares and managed investments you hold directly. It generally does not apply to a rental property because a super fund cannot buy residential property from you personally. The third is staging the sale across separate financial years. If you hold several parcels of shares, or a property can be legally split into separate titles, selling a portion in one financial year and the remainder in the next keeps each year's taxable gain smaller, and the discount applies fresh each time, rather than one large gain pushing you into a higher tax bracket in a single year. The fourth is borrowing against the asset instead of selling it. A line of credit against a share portfolio, or a redraw on a mortgage that is mostly paid off, gets you cash without triggering a sale at all. It carries interest, so it only makes sense for a genuine short-term need, but it buys you time to sell later on your own terms. I used to think the smart move was always to wait for the ideal moment to sell, I said, as much to more than one person, more than once. Then I watched a handful of people hold out for a better market that never really arrived, while the bills kept coming anyway. That changed how I think about this completely. There is one thing that stops most people from actually using any of these four options, and it is not a lack of information. Let us talk about that next. Here is the part that is not really about tax at all. Most people who reach their late 50s or 60s got there by being good at their careers, at solving problems, at controlling outcomes. That success creates a quiet belief that you can also control the exact right moment to sell an asset, the same way you controlled a project deadline or a business decision. The market does not work that way, and neither does a piece of property sitting in one suburb. But feeling that loss of control is uncomfortable, so the mind reaches for a plan that at least feels like control, which is waiting. It is completely normal to feel this way. You worked hard for this asset. You do not want to hand any more of it to tax than you have to, and that instinct is not wrong. The problem is that the market and the tax office do not know or care that you are waiting for the right moment. I will be honest, I fell into this exact trap myself. I held on to a share portfolio through the 2020 downturn because I was convinced I could time the recovery. I came out fine in the end, but it was closer to luck than skill, and luck is not something you can plan a retirement around. Try shifting the question. Instead of asking, when is the best time to sell, ask what actually happens if I do not sell now. If the honest answer is the market might fall further, that is worth acting on. If the answer is only that you might pay a little more tax than some theoretical perfect scenario, run the actual numbers, because the tax difference is usually smaller than people assume. Now that you understand why this trap catches so many people, let us get practical. Here is the step-by-step version of the four strategies. Step 1 is the partial sale. If Peter sells 25% of his rental property instead of the whole thing, by bringing in a family member as a co-owner or selling a fractional share, his portion of the gain is $75,000 on that quarter. After the discount, only $37,500 is taxable, and at his 30% rate, that is $11,250 in tax. He walks away with roughly $138,750 in cash from that quarter alone, while still owning 3/4 of the property and all the flexibility that comes with it. Step 2 is moving eligible shares into your superannuation fund rather than selling them on the open market first. This still triggers a capital gains bill at the time you transfer them, so it is not a way to skip tax altogether. It is a way to choose where the growth gets taxed from that point on. Inside a fund, long-held gains are generally taxed at an effective 10%, well below what most retirees pay on income outside super. There is a cap on how much can sit in a tax-free pension account, the transfer balance cap, sitting at $2,100,000 from 2026, so this only suits people with room under that limit, and it is worth checking the exact numbers with a licensed advisor before you act. This step applies to shares and managed investments, not to a rental property held in your own name. Step 3 is staging the sale across separate financial years. If you hold several parcels of shares, or your property can be legally split into separate titles, selling a portion in one financial year and the remainder in the next keeps each year's taxable gains smaller, and the discount applies fresh each time rather than one large gain, pushing you into a higher tax bracket in a single year. Step 4 is borrowing against the asset instead of selling it. A line of credit against a share portfolio or a redraw on a mortgage that is mostly paid off gets you cash without a sale at all. It carries interest, so it only makes sense for a genuine short-term gap, but it buys you room to choose your own timing on the actual sale later. If you've made it this far, you are already ahead of most people who just wait and hope. Hit subscribe now, because the next video covers a different trap entirely: the tax hit your family can face on what is left in your super after you are gone. So here is the recap. The trap is believing you can control exactly when you sell an asset, like a property or a concentrated share parcel. The real cost of that belief can run into tens of thousands of dollars, whether that is a market drop while you wait or a rushed sale when life forces your hand. The fix is not finding the perfect day. It is building in options ahead of time: a partial sale, moving eligible shares into super, staging a sale across financial years, or borrowing against the asset for a short-term gap. At Aussie Retirement with Bob, we do not chase perfect timing. We build plans that still work when life throws you a curveball, because it usually does. If this helped you see your own situation differently, subscribe and turn on notifications. And if you know someone sitting on a property or a share portfolio, quietly worried about the tax bill, send them this video. It might save them a lot more than it costs them 10 minutes to watch.